Well, stocks accelerating their gains as we're at session highs. Earnings keep rocking. Well, some would call it the CP effect too, right? But these earnings, folks, I think they've actually added a layer of justification for this rally. And take a look at these second quarter earnings releases. So far, 82% of companies have beat the street, 16% missed. Now, we've lost 1.9%. That's your average blended return. It's a lot, but the street thought it was going to be down 43%. On the revenue side, 64% beat, 36% miss. Your blended loss down less than 11%. We thought it would be closer to down 12%. So earnings have done extraordinarily well. We're bringing now to join me Point View Wealth Management's David Dietze. David, you manage $6.5 billion. So you're watching this day to day, this close. It feels like the last few days, the market is now reacting to earnings, particularly earnings in non-tech names, in a really positive way. I know the numbers were low. I know expectations were low. But are you impressed with what we've seen so far?
Yeah, absolutely. Because as you just cited those statistics, although we're down, we're beating the estimates by a percentage that we normally don't, both with earnings and revenues. But I think more importantly, it's setting us up for great results going forward because, you know, with the low earnings now, a year from now, 6 months from now, people will be comparing the current earnings versus what we have now, and those comparisons are going to look very, very favorably. And remember, Charles, of course, stocks look forward, they don't look back.
You know, it's interesting you said that because although a lot of companies are still pretty opaque when it comes to guidance, we had a lot of earnings warnings. Almost, you know, companies that do have visibility overwhelmingly are saying things are going to get better, and I think that makes also is one of the reasons the S&P is catching up. We could see the Dow go positive this month for sure. But if that happens, there's talk about rotation now. That theme keeps coming up, right? And there are four sectors I think these so-called value investors find attractive. I will tell you, I'm much more excited about industrials and materials, but financials and energy also get a whole lot of attention, particularly if these names can break out. We've got some key breakout levels. Where are you right now in terms of the measuring your portfolio, David? Are you in some of these names? Are you looking at some of them?
Absolutely. So, Charles, we love the industrials like you, and there's really three great reasons why it makes sense to take positions in industrials. First of all, they have lagged in the rally, so valuations are much more reasonable. Second, of course, when you look at what the global economy is doing, we're seeing manufacturing indexes in Europe get well over 50, well past expectations. Ditto in China. I think it's just a matter of time before manufacturing really takes off here. Third, of course, is the shine has been taken off the dollar, makes us a little bit more competitive. I think that's going to be a tailwind behind U.S. manufacturing. And finally, these interest rates are going to stay low for years. When you're looking at capital expenditure, when you're looking at manufacturing, interest rates come very importantly into the mix. I think that's why industrials have a great future ahead of them. I'm
extremely overweight industrials, but I will say I'm looking at today's session. So energy is down, financials are down, healthcare is down, materials are down, so only industrials are up. And there's a lot of folks out there, a ton of money, that's saying, hey, until I see a real serious move, I'm going to stick with communication services. Look at the names that are leading today's session. Facebook, Twitter, Disney. People are sticking with those names. Is there anything wrong with riding that wave until the wheels come off?
Well, certainly. I mean, you know, I think we're all looking for this entire market, for this entire economy, for good news on the vaccine front. I'm optimistic. Over 200 companies are working on it. The United States just gave a $1 billion contract to J&J for something before the end of the year. I think once that comes out and we see some sort of light at the end of the tunnel in terms of return to normalcy, I think that could be the trigger for a rotation, as you say, from the stay-at-home and secular tech plays into some of these more cyclical, better value plays.
David, jobs report out tomorrow. Your thoughts? Do we need a big beat? You know, because if you get another big beat, maybe that makes Congress stall a little bit and takes away their urgency. But do we need it for this economy and this stock market?
Well, certainly the jobs report is backward looking. I'm optimistic here. Of course, we saw a better than expected weekly jobless claims. The ADP was a little disappointing, but when you couple it with the big revisions in June, I thought that was okay. I think at the end of the day, the stimulus bill, getting that passed is more important because the stimulus bill is going to affect people's sentiment and prospects looking forward, and we're going to tilt away from looking backwards to the July jobs numbers.
Yeah, I mean, I just don't the heck they're thinking about down in Washington, D.C. I've been saying pox on both houses. We'll see. David, always appreciate your wisdom when it comes to these markets. You have been spot on, my friend. Thank you very much.